Hello everyone, actual. Today is 24th of July 2022, and today's topic for 5 minutes would be asset share. Now, asset share is a very important topic with regards to with profit policies or participating policies, and we are going to cover this in detail in August after the exams are over. There would be a kind of a master class like many sessions relating to with profit policies, because with profit policies is the place where maximum judgment of appointed actuary or the actuaries are required, and that's where it is difficult decision making. Like you in actuary, you get paid for decision making, and this is where decision making makes a difference, right? Now the any discussion for with profit policy start with asset share, and I think most of us probably know what asset share is. Asset share, as per me, is a fund, right? You have a policy, and that policy, whatever, suppose you have issued a policy on say 1st Jan 2021, and today is 24th of July 2022. Whatever fund that has been accumulated with respect to that policy, because of the premium, because of the investment income, because of n number of other things, that is actually the asset share. But that is a that although it do not represent the actual asset share, you kind of get the idea that that fund that has been accumulated is the asset share. In that sense, it is very similar to the retrospective reserve that we have studied in CT5 or CM1, whatever that subject is called now. Prospective reserve is kind of looking forward, right? Retrospective reserve is looking backward. That's why the name retrospective. It also is kind of similar to the the risk neutral valuation and real life valuation, like risk real world valuation, right? So if you don't remember risk neutral valuation and real life valuation, you need to see my the ALSM video of SA2 chapter, where I've kind of clearly explained what is risk neutral, and I probably will also cover that in this 5 minute video in a later date. So what it means is everything that has been accumulated in for a policy is actually the asset share, but it's actually not the case. There will be some deduction, something which will inflow something, and that is the purpose of this video. So I mean, at the start, we can think that the asset share is a fund, right? And that fund represent what has been kind of accumulated for that policy, and then there will be some addition or deduction. So that we'll see now. So what asset share actually is kind of probably better defined rather than in SA2, but in the guidance note 6, which is issued by Institute of Actuaries of India. So here you see asset share for a policy grouping at a given point of time is the accumulation of the premium received, right? So you have issued a policy on 1st Jan 2021, and you have received some premium for that, plus the investment income, right? The investment income that is kind of paid, and you earn some investment income by investing your premium from the inception of the policy, right? From the issuing date. With deduction for benefit payments. So if you have made any benefit payments, if you have made any commission, if you have made any expense, obviously you are going to pay commission, right? Obviously you have incurred any expenses. Benefit payment may not be required, or may not be I mean, there may not be any actual benefit payment, because obviously, I mean, some if a person has died, then the policy is not in force, so it may not be the actual benefit payment. But you are obviously, there is some expected payments that is kind of getting deducted, and a reasonable cost of capital, cost of guarantees, and contribution from miscellaneous surplus, right? And transfer to the shareholder. Now, this up to this portion we can easily understand, right? Benefit payment, commission, expenses. We can see that okay, these are the, there is a policy, there is a fund that has been accumulated. Something is flowing in very easily, like premium is flowing in, investment income is flowing in, and deduction like benefit payment, commission, expenses, the tax, these are going out, right? So we can visualize that very easily. The problem starts with the reasonable cost of capital. Like we cannot visualize what is cost of capital here in this case, right? And guarantees and contribution from miscellaneous surplus. What is miscellaneous surplus here? And also transfer to the shareholder, right? That portion is, these are the concepts that are not very clear. So what do you mean by cost of capital? Now, when we know that if you are kind of valuing a policy on a prudent basis, then there would be a capital. Then life insurance is a capital intensive business, right? Because you would require more money at the initial level than you kind of have to, then you'll get, right? The premium will be under 100 rupees. And if the person dies, then you need to pay 1 lakh rupees, right? So it's a capital intensive business, especially when you are reserving on prudence basis. There will be also some acquisition cost. So that's what we call initial strain, which is the initial expense plus the time zero reserve. So there is a huge cost involved. There is a capital involved. Without some capital, you cannot start life insurance business, right? You require that capital at the start. So an insurer do not have that capital. The shareholder kind of need to provide for that capital, or a participating policy fund do not have that capital. The shareholder provide for the capital. Then because of that capital that they provide, they require some return. Otherwise, there is no benefit for them, right? So that return they are kind of expecting is called the cost of capital. So they might put 1 lakh rupees today, but they might be expecting 10% return over that capital, right? Because they're taking additional risk. So that is the cost of capital. What is the cost of guarantee? And sometimes there is another term called cost of insurance. Right? So cost of insurance, cost of guarantee, sometimes these are used interchangeably. Sometimes they are used differently. So what is meant by cost of insurance, and how and in what sense they are kind of different? So cost of insurance is the basic profit, right? In with profit policies, you are starting with, say, sum assured of 1 lakh, right? That is your basic profit. So whatever the mortality charge for that profit, like your sum assured into the mortality rate at a particular year, is your cost of insurance, right? I think many people will probably know that already. However, over the period of time, you give bonuses, right? The reversionary bonuses, there will be terminal bonuses. So you give bonuses. When you give bonuses, the sum assured increases, and that increase over and above the basic benefit is called the cost of guarantee, right? Sometimes the people, like I have seen people who are kind of using cost of guarantee, which includes kind of cost of insurance, like cost of insurance, because it is the basic benefit, and when you if you consider only the guarantee, and then the basic benefit is also a kind of guarantee that the insurance is providing. So sometimes cost of guarantee consists of cost of insurance, but if you ask me, I prefer to use this separately. Cost of insurance would be only for the basic benefit, that is the insurance part, right? And then you whatever extra guarantee you provide, that would come separately as cost of guarantee. Contribution from miscellaneous surplus. Now, miscellaneous surplus can be n number of things. You can surrender a policy, and if you surrender a policy, then there might be a surplus or there might be a deficit, right? You can also write non-participating policies in participating policies, a concept that we'll see when you consider participating policies in detail, and that might generate surplus, right? There might be surplus from over distribution, under distribution of surplus because of smoothing, and that might generate surplus, right? There might even be surplus for tax, like overall the company may be in loss, but the participating fund may be in profit. So because the participating fund in profit, you are kind of deducting tax, but because the company as a whole is in loss, you are not required to pay tax, and that tax benefit that you are getting might be added back, which will be kind of creating surplus, right? And finally, the transfer to the shareholder. Now, obviously, in participating policies, I think most of us know that the reason it is called participating policies is because policyholder are kind of participating in the profit. The shareholder obviously gets certain portion of return. In Indian scenario, in UK scenario, it is 10% belongs to the shareholder of the surplus, and 90% belongs to the policyholder, right? So this 10% that belongs to the shareholder needs to be given to the shareholder. That is also deducted. So if we kind of summarize this, so you say you get 100 rupees as premium, then you get 10 rupees as investment income, right? So 100 plus 10, 110, then you give some payment for benefit, right? So then you give some payment for commission, for expense, for tax, so 10 rupees each. So 110 minus 40, right? So then that gives you 70 rupees. Now the remaining thing, cost of capital, cost of guarantee, contribution from miscellaneous surplus, these are non-cash item. Like you cannot see that, right? Cost of capital, you cannot see that. It's deducted, but there is no physical existence. So once again, cost of guarantee, you cannot see that. These are deducted, but there is no like physical existence of it, right? Because there is a guarantee, we have to kind of deduct it. We know that in the future we have to pay it. Because of that, we have to kind of provision for them from today. And we are providing that guarantee. So it's not correct to show the fund as 70 rupees, but it should be less than that. So that's why it will be subtracted, but it's a non-cash item, right? You cannot see it flow. Similarly, so that's what cost of capital, cost of guarantees. These are non-cash item, and that is why it's difficult to visualize. That's why when I told that it will be it is the difficult part to understand. That's the reason, right? And finally, there will be contribution of surplus, so that you can visualize. Once again, it would be difficult to visualize because you are suppose a surrender has happened, you don't know how much you have kind of lost, how much you have gained. It's a interplay between what you have lost today and what you have lost. What you have lost again today and what you have lost from the future, right? So it's difficult to understand, and that's why these are kind of difficult to understand. However, the things that are kind of easily understood would be the items that that is kind of physically existing, like transfer to the shareholders, that is physically existing. We know that this amount of money would flow from the with profit fund to the shareholder fund, and we can see that. But the cost of guarantees, the cost of capital is difficult to see that, and that's why it is difficult to kind of gauge that what is going inside there. Right, so that's the calculation of asset share. And finally, although asset share is kind of synonymous with the participating policies, it is used in conjunction with that, especially to calculate the surrender value. But asset share can also be calculated for non-participating policies, not necessarily that it has to be calculated for non-participating policies. And in fact, for providing surrender benefit, asset share is calculated. That is a very important, criteria. So asset share can be calculated for any types of policies. It's just that the use of asset share for participating policies is way more important and way more prevalent as compared to non-participating policies. So if you like this 5-minute series, although I think today I've taken some more time than 5 minutes, but if you like this video, please hit like, share, subscribe, hit the bell icon, provide any comment for feedback. Like if you don't understand something, please ask a question in the comment section. And yeah, see you tomorrow in some other video. Thanks for watching, and please share as much as possible. Thank you.